Hello, this is the MMAP August update training. The topic this month is long-term care insurance. So in the July update training, we talked a little bit about long-term care options and financing. This month, we're going to focus on long-term care insurance. But as a recap, we're going to talk a little bit about what long-term care is, how much does it cost, and who's paying for it. So long-term care is different than medical care. Long-term care helps someone live as they are instead of trying to improve or correct a medical problem. And so the way that this usually looks is that it's usually helped with activities of daily living. And these would be things like personal care, help with showering, help with toileting, help standing up or sitting down, help with walking, help with getting into or out of bed, those types of things. But also these services could be respite care, which is services that help give the caregiver a break, adult daycare, which are where you would send your loved one to an adult daycare facility and they would spend the day there and engage in activities. This can also be home health care. Long-term care can be delivered in a variety of settings. It could be delivered in a nursing home or an assisted living or in somebody's own home. So the costs for long-term care are quite expensive. If somebody were to be in a nursing home for a year, using 2010 dollars, there's an average cost of $78,000 per year for nursing home care. Likewise, if somebody wanted to be in an assisted living facility, and for so many people that's an attractive option where they can maybe have their own apartment but get services in there, that could be up to $39,000 a year. Home health care, if somebody wanted to get services in their own home, it could be $21 an hour for a home health care aide. Last month's seminar we talked about if somebody wanted like housekeeping, that might be $19 an hour on average. And then if somebody wanted a private duty nurse, so somebody to provide nursing care to the patient, but private duty nursing is more of like those personal nursing services that are not considered medically necessary by Medicare. That's $50 an hour. So long-term care can be quite expensive. Who pays for long-term care? Well, there's a variety of different sources. Somebody can pay, self-pay for long-term care. And the coverage they would get is you get what you paid for. So the great thing about self-pay is that it's very flexible. So if part of your long-term care service, you wanted your caregiver to do the hula dance, that would be something that you could arrange with the care provider and see if they would be willing to do that for the money that you pay them. But because, you can get as much care as you can afford, but then if you can't afford much, that isn't a limitation as well. Like another source of long-term care financing is the family's paying for it. And so again, you get what your family pays for, and so this could be, great. The sky could be the limit if your family, is well off and can afford it. Or this might not be very much care if the family can't afford very much. So, you get what you pay for. Long-term care insurance, yes, it covers long-term care, but the coverage really depends on the policy. Each policy is going to look very, very different. And we'll talk about that in just a little bit. Medicaid covers long-term care, and it absolutely does cover long-term care, but somebody needs to qualify for Medicaid, so not everybody does qualify for Medicaid. And a person, if they qualify for Medicaid, can get coverage in a nursing home or through PACE or through My Choice. Also, VA covers long-term care, and again, this is something that somebody would need to qualify for, so not everybody would qualify for veterans benefits. And they would provide coverage in a nursing home or through an in-home service. Medicare also covers long-term care, but not really. Some of their services, like skilled nursing facility, home health care, and hospice, they're medical services. They're not long-term care services, but they kind of are in this area where either if somebody is using one of these services, they're using it as part of a transition to long-term care, or maybe somebody's using these services in addition to long-term care. So no, Medicare does not cover long-term care services. There are just a couple services that couple medical services that may be more closely related to long-term care, even though technically they're not. Finally, Medigap. Medigap does not cover long-term care. It's a medical insurance that helps pay for the Medicare copays and deductibles. But some policies sold before 2010 had an at-home recovery benefit that provided up to $1,600 per year for reimbursement for home care. And this would be for while somebody's recovering from surgery or maybe an accident. You know, somebody broke their leg, or if they had heart surgery and they needed some services up and above what Medicare home care would pay for, there was this at-home recovery benefit. Now, even though these policies are obsolete, they're no longer sold after 2010, people who had these policies while they were being sold before 2010 have the option to still keep these policies. So if somebody does still have this policy, their benefits are grandfathered in, and they may have this limited at-home recovery benefit. It's probably few and far between that you would ever see this happening, but it's a possibility. So what are the chances of somebody even needing long-term care? Well, it's kind of great. So the life expectancy after the age of 65 today is a little bit longer than it was in 1940. 70% of people who reach the age of 65 will need some form of long-term care at least once in their lifetime. And 35% of people who reach the age of 65 will go to a nursing home at least once in their lifetime. As of 2010, 11 million Americans needed long-term care, and only 1.4 million of those were living in a nursing home. So if we're looking at what are the odds of needing long-term care, well, as somebody, surpasses the age of 65, the likelihood is pretty great. So let's talk about long-term care insurance, what it is, and is it necessary? So is long-term care insurance necessary? Well, long-term care insurance is not for everybody. It's for a specific group of people. It's really for people who have some money that they want to protect. So it's not going to be for any of the lower income folks, people that would qualify for Medicaid. And when I say that, I'm including long-term care Medicaid, where there's some asset protections for the community spouse that are pretty generous. So if somebody has even a little bit of assets, they may not want long-term care insurance because they may qualify for Medicaid long-term care. This is for people with quite a few assets that can afford the monthly premiums for long-term care, this is a way to protect their assets. So people who should not get long-term care are people who can't afford it. If you can't afford the premiums, if you don't have a lot of assets to protect, people whose only source of income is Social Security, people who are having a hard time making ends meet, people who are on Medicaid, those people don't need long-term care insurance. People may want to consider buying long-term care insurance if they have a lot of assets or a really robust income. If somebody doesn't want to use their assets and income to pay for long-term care, they want to just protect it and leave the legacy to their kids or their grandkids. If they can pay the insurance premiums, including possible premium increases without a problem, this becomes very important because not only can the premiums increase after each year, like that inflation increases, but also premiums can increase as somebody gets older. So, that is really something to think very carefully about. People may want to consider long-term care if they don't want to depend on the support from others and they want the ability to choose where they receive care. Also, it's really important to note that a lot of people will call us asking about long-term care insurance when they're at the point of need. So, oh my goodness, I think I'm going to have to go into the nursing home very soon. I need long-term care insurance. And that's, if somebody needs the long-term care, they have passed the point where getting long-term care insurance is appropriate. Long-term care insurance is something you get before you need it. The thing is that these long-term care insurance companies will underwrite, and the person who needs long-term care like now is probably not going to qualify. So this is a planning tool. This is not a point of crisis tool. There's certain types of policies that somebody can get. A person can get an individual long-term care insurance policy. Most long-term care insurances are individual policies. Some employers actually will provide a long-term care insurance benefit that is available at an additional cost for their employees. Some trade associations or alumni associations may have long-term care insurance policies available for purchase. There are some policies that are sponsored by continuing care retirement communities. Those would be those communities that have like a nursing home and assisted living and independent apartments all on one campus. Some of those communities have long-term care insurance policies that people can purchase as they're entering into that community. Some life insurance policies have a long-term care rider. There are some annuities that people can get to pay for long-term care. And then finally, there are some states that have long-term care partnership policies, which are special partnerships between the Medicaid program and long-term care insurances, which this would be something where a person would get into the special long-term care insurance that they would agree to pay for, and then the long-term care insurance would kick in, and it would be a very limited benefit. Once that benefit is expired, then Medicaid would kick in. So the partnership policies allow people to protect a little bit more assets while reducing Medicaid expenditures. Michigan is planning on developing a partnership policy. So in the next year or two, you may see something from Michigan, but we don't have one in full effect yet. Now, for long-term care insurance policies, people can choose to either buy a tax-qualified plan or a non-tax-qualified plan. The tax-qualified plan has some financial incentives, but it's a little bit more structured. So the tax-qualified plans have monthly premiums that are tax-deductible. The benefits that are used to pay for long-term care, so once that long-term care insurance is starting to pay a benefit to the person, that money is not considered income and not taxable. However, the trigger for the federally tax-qualified policies, so the trigger that would trigger the benefits, have like the long-term care plan start paying out, would be that a person cannot do 2 ADLs, activities of daily living without help. The federally tax-qualified plans cannot use medically necessary as a benefit trigger. These policies cannot, they can require that a person is chronically ill or having a disability lasting 90 days. And policies that cover cognitive impairment must use substantial supervision as a trigger. So there's some protections, there's some structure, but there's also some tax incentives for these tax-qualified policies. Now, the non-tax-qualified policies, premiums may or may not be tax-deductible. And the reason why there's some ambiguity there is that according to the National Association of Insurance Commissioners, that the Department of Treasury and Congress haven't clearly defined whether or not that's allowable. Likewise, if the long-term care benefits that are paid out may or may not be considered income. And again, according to the National Association of Insurance Commissioners, they're waiting for some guidance from the Department of Treasury and Congress to see what's allowed under law. And so that ambiguity is there because the powers that be haven't clearly defined it yet. Now, as far as the triggers and any other policy provisions, there really aren't any requirements for the non-tax qualified plans other than what's set forth by federal and state law. So these policies, there's a lot more flexibility to the non-tax qualified policies. So that also might mean that there's less protection too. So things to watch out for. How do long-term care policies work? We're going to talk about who, what, when, where, and how services are covered in a nutshell. So how are benefits paid? Well, there's 3 types of methods. There's the expense incurred, indemnity period, and disability method. The expense incurred method is how most policies pay their benefits. And really what this is it pays only when eligible to receive benefits, and then it either pays an expense or a dollar limit of the policy. So what this looks like is if the trigger is met, so let's say the trigger is that somebody needs assistance to ADL, how the expense, so that trigger is met. How it works is the person, depending on the care setting, so they may have like nursing home care, may have $100 per day benefit, or assisted living, it may have $1,500 per month benefit. Whatever that looks like, whatever that benefit is. when that person is eligible to receive services and they're getting that benefit, then that policy would kick in and either pay the expense or reimburse that person up to that policy's dollar limit. The second method is indemnity method. So this pays when somebody is eligible for benefits, so when that policy is triggered, and the trigger is going to vary from plan to plan, but most often it's going to be 2 ADLs. Somebody needs assistance with 2 activities of daily living. So the trigger is met, the person's eligible for benefits, and they're receiving services. And the indemnity method sets a dollar amount based on the service received. So there's a little bit more flexibility with this. The person's going to get X number of, whatever that benefit says for whatever type of service. So they're getting home health care and they get $100 per day home health care, that's fine. The flexibility is that a person doesn't need to use all of that money, right? For the indemnity method, we're just going to get that money based on what that policy says, so they'll get that X number of dollars today, regardless if they've used that amount of money in services. They're getting a service that maybe one day they only received an hour of home health care services. They'll still get that full benefit amount of whatever that is. The disability method is way more flexible. For the disability method, the person is only required to meet the benefit eligibility criteria. And once they meet the eligibility criteria set forth in that policy, they get a daily benefit even if no services are received. So, I meet the criteria, I don't have to receive services, I can still cash it. Policies can also have pooled benefits or joint benefits. Pooled benefits can either cover more than one person or cover more than one kind of long-term care service. So joint benefits are a type of pooled benefit, and that would cover more than one person, such as spouses. If you have a joint benefit, it would cover both spouses. Another type of pooled benefit is long-term care services. They can pool the services together. So how these policies work is there's usually X number, the policy will pay out X number of dollars for nursing home care, X number of dollars for assisted living, X number of dollars for home health care. And you get more money for nursing home, less money for home health care, for assisted living in the middle. That's typically how it works. Well, if you use the pooled benefit for the long-term care services, instead of having the separate line items based on type of service, a person can choose to pool all of those benefits together. And so it allows more flexibility. And it allows the person to have more control how things are spent. Now, what services are covered under long-term care insurance? Well, long-term care insurance policies can cover any of the following, but they do not have to cover all of the following. So, long-term care insurance may cover nursing home care or home health care or respite, hospice, personal care in the home, services at assisted living, services at adult daycare, or services in community facilities, or homemaker services. So they can choose to cover any combination or all of them. It's really going to be dependent on the policy itself. So people will need to read to make sure they understand which of these services are covered or which combination of these services are covered. Now stay tuned, Michigan has its own set of requirements on what needs to be covered. So we'll go over that in a little bit. So where are services covered? Well, each policy is going to be different, but care settings can include nursing homes, assisted living, and that can either be licensed or unlicensed, or it could be in-home services. And again, stay tuned for the Michigan requirements. Now, services, there's some services that aren't covered. There are these exclusions and limitations for long-term care insurance policies. So one exclusion is mental health or nervous disorders are not covered under long-term care insurance policies. That's with the exception of Alzheimer's or dementia, but any mental health or nervous disorders will not be covered. Alcohol or drug addiction is not covered under long-term care insurance. Illness or injury caused by an act of war, that would not be an exclusion or limitation. Chances are that would be covered by the VA in most situations. Treatment in a government facility or the government has already paid for, so no duplication of coverage. Also, things that VA or Medicare has already paid for, long-term care insurance would not. And attempted suicide or self-inflicted injuries are not covered by long-term care insurance. How much coverage will someone have? Well, there are limits to coverage. Those limits will vary based on plan. A person can design their own limits, but you know, the more generous the policy, the more generous the premium. So there's a maximum benefit limit, and that would be the total benefit that the insurance company would pay over the lifetime. It can either be worded in time or dollar amount. So a plan may have a 5-year maximum benefit, meaning that after they pay for long-term care services, after the insurance company pays 5 years worth of long-term care benefit, it's done. They've exhausted that benefit. Or it can be worded in dollar amount. For example, you know, they may have a $500,000 like maximum benefit. So after $500,000 of long-term care services are paid for by the insurance company, then the person has maximized that benefit. So those would be things that people would need to watch out for in their policies so that they know what's covered. Also, there's a daily, weekly, and monthly benefit limit, and that's going to differ by the type of service. So, for example, a nursing home may have $100 per day limit, or home health care typically works at 1%. So they may have like it covers 50% of home health care with a maximum monthly benefit of X number of dollars. And again, this is really going to depend on the policy. So how does somebody activate their policy? Well, they activate their policy through benefit triggers. So some of the benefit triggers can be activities of daily living. That's the most common type of benefit trigger. And so these are bathing, going to the bathroom, dressing, eating, transferring, those types of things. If people need help with any of these, that might be a benefit trigger. They may require 2 or more, you know, somebody would need assistance with 2 or more activities of daily living in order to trigger the benefit. So they would have to read their policy to see what that says. Another type of benefit trigger could be cognitive impairment. So, you know, a person should be aware, ask about triggers for cognitive impairment. This can be tricky, though, because if cognitive impairment is covered under the long-term care insurance policy, the person may want to make sure that the trigger is not just limited to activities of daily living. So activities of daily living may require hands-on assistance, but people with cognitive impairment may require supervision. So that might be something to look for in a policy, is to make sure that the triggers for cognitive impairment are appropriate or acceptable to the policyholder. Another type of benefit trigger would be doctor certification of medical necessity. There's some non-tax qualified plans that have that. And then some of the older policies will require prior hospitalization as a benefit trigger. So when would benefits start? Well, it would depend on what that elimination period is, and the elimination period is either also called a waiting period or a deductible, and it's measured in days. So if somebody has a 20-day elimination period, they would have to trigger the benefit with the insurance company, and then once that benefit's been triggered, they would pay the first 20 days in long-term care costs out of their own pocket before the long-term care insurance would kick in. So the lower the elimination period, the higher the monthly premium, because, you know, it's a pretty robust feature. You know, if you have a 0-day elimination period, that's pretty amazing. Now, the elimination period can be based on an episode of care, so that's something to watch out for. Meaning, if somebody last November, somebody triggered the long-term care policy and started receiving benefits, and let's say in March they decided that they weren't going to use long-term care, that their daughter is going to assume all of those responsibilities. So they used their benefit from November through March, and then somebody else took over. Daughter's taking care of everything. They no longer need to use those benefits. Well, if they need to use those benefits again in September, then it's going to be a new episode of care. So they may have to pay that, or may have to go through that elimination period again. So it's just important for the person to understand their policy. Plans can offer inflation protection, and so this would adjust the benefits based on inflation, meaning that if I buy a policy in 1990 and I keep on paying my insurance premiums, and today I need to use that long-term care insurance, that when I get my benefits, that my benefits are paid based on today's rates, not 1990s rates. So that's what the inflation protection does, is it makes sure it adjusts the benefit based on inflation. However, the inflation protection is costly. It can increase the premium by 25 to 40%. Now, there's two types of inflation protection. There's the automatic inflation protection, which automatically adjusts by a fixed rate every year. For example, it might be it'll specify what that fixed rate is in the policy. So if it's a 5% protection, each year it will adjust the benefits by 5% each year, so that it keeps up with the current cost of things. A person can have this either for the life of the policy or a specified time, and the inflation protection can use either simple interest or compound interest. So it's, again, important for that person to be aware of how that interest is calculated. The second type of inflation protection is special offer or non-automatic inflation protection. This would be for people who increase their benefits every couple of years. So if a person maybe gets long-term care insurance 10 years ago, but they can't afford much, they just get kind of this bare bones policy, and 2 years later, they say, you know what, I can afford a little bit more, I'm going to re-up my policy and I'm going to get some more benefits. And then 2 years later, they say, you know what, I'm going to have a little bit more benefit added to my long-term care insurance. And 2 years later, do the same thing. Well, for those people, because they're increasing their benefits every couple of years, they can work through like a special offer, inflation protection for their policy. There's some other benefits that people may elect. Third-party notice. This would be a benefit that would allow the insurance company to contact somebody if the insured forgets to pay the monthly premium. Waiver of premium is another benefit that somebody can choose and pay for as part of their monthly premium. And what that is when benefits are triggered and the insurance company starts paying out benefits, then the person would no longer have to pay their monthly premium. Another benefit that's available through long-term care insurance is premium refund at death. So a person would get the monthly premiums that have been paid over the course of a lifetime minus the benefits that the long-term care insurance paid out. However, in order to get this benefit, the policyholder must have been a policyholder for a specified length of time. So it might be 10 years or so that somebody would have to have this policy. Also, downgrades are another benefit, that if somebody's having a hard time affording their long-term care insurance, they can contact the company and lower their benefits and get a reduced premium based on the benefits they got rid of. So what happens if, this should say, if I cannot afford the premiums after I buy the policy? Well, there's non-forfeiture benefits that somebody can choose to pay for at the time they sign up for the long-term care insurance policy. And this would be if somebody drops the coverage, they would still get benefits after that coverage ends. So this is also called a reduced paid up policy, a shortened benefit period policy, extended term policy. But it costs more for this option. There's also a contingent non-forfeiture benefit, and it's an option where the policy lapses and the premium increases beyond a certain point, and the insurance company provides an option to still have some benefit. Will health status affect the ability to buy a policy? Absolutely, yes. Companies do underwrite, and so they look at a person's medical history in order to determine if they're going to insure them and how much they're going to charge them. It's important that people are honest on their applications, because if a person lies on the application and the company finds out about it, the company can rescind the policy. Also, the company can impose pre-existing conditions or can impose restrictions for pre-existing conditions. So they'll look back a certain period of time. So that look back is going to vary. They're going to look at like family history or your history. So if, for example, you're diagnosed with something 20 years ago, and you've had this disease for 20 years, and it's getting progressively worse, well, that's going to make a difference. And so the look back is going to vary based on each company. Also, companies can still offer a long-term care insurance but exclude benefits for pre-existing conditions. So that might be the outcome of underwriting as well. Most long-term care insurance policies are guaranteed renewable, meaning that the company would offer the same policy, renew the policy, but they can increase the price. So guaranteed renewable just means that, the person would have the option to renew the policy. It has nothing to do with a price freeze. And actually, in Michigan, the prices work a little bit where insurance companies can increase the price to whatever they want to increase it to. They just have to have a rate filing with the Department of Insurance and Financial Services and prove there's a 60% loss ratio. So what you'll see sometimes, especially with long-term care insurance, is prices increasing quite drastically depending on how old somebody is. Now, there are some Michigan protections. In the state of Michigan, long-term care insurance must provide coverage for all levels of the nursing home care, including skilled nursing care, facility care, intermediate, and custodial care. Long-term care insurance in Michigan must provide coverage for home care services. They must pay for care without a prior hospital or skilled nursing facility stay. They must be guaranteed renewable and offer the inflation adjustment option. There can be no coverage limit for pre-existing conditions for more than 6 months. There can be no exclusion or limited coverage for Alzheimer's disease. And Michigan long-term care insurance policies sold in Michigan must provide a 30-day free look period. And that's a really great thing for people to utilize, where for the first 30 days, somebody signs on the dotted line and they have this policy. They have up to 30 days to really review that policy with a fine-tooth comb to make sure that what they signed up for is what they understood, and they can cancel it anytime during the first 30 days. So some tips, for shopping for long-term care insurance is to check with several insurance companies or agents. So important is check companies' premium increase history. Absolutely should do that. You don't have a crystal ball and you don't know what the next rate filing is going to be. However, you can look at their history to kind of come up with an educated guess. Be sure to get the name, address, and phone number of the agent. That is so important, and it seems like a no-brainer, but so many times, especially with long-term care insurance, there are some really great agents, and then there are some con artists, and there's some people that maybe they got a business card, but that business card didn't have complete information. Maybe it didn't have the agent's name, address, but it had like the phone number to a phone that's no longer in service. So really important to make sure you have all that information. Never buy long-term care insurance in a hurry. Always take the time to thoroughly review and make sure that that's what you want to sign up for. Take the time to understand that policy. Don't buy multiple policies. Check the limits on benefits. Never pay cash and use the free look period. Long-term care insurance fraud, it's out there. Usually it's unscrupulous agents representing a product, another product as long-term care insurance, and not really being honest about what they're selling. Sometimes they may require somebody to pay in cash, and that's a huge red flag. Another red flag is if the agent is pressuring somebody to buy a policy on the spot. The offer expires tonight at midnight. If you don't sign up for this deal now, it's going to go away. Well, that's never a good thing, and the person should run, from that policy. If anybody has a long-term care insurance fraud report, they should report it to the Michigan Department of Insurance and Financial Services. So some counseling tips. The MMAP program can provide some general guidance with long-term care insurance policies. However, there's a lot of things that really are probably better suited for an elder law attorney. So we can provide them with the toolkit. It should have been emailed to you, but your site coordinators will have them. We can help explain the provisions. If you're comfortable, we can help compare the plans. And really beyond that, it's referring to an elder law attorney. If they're going to make this financial investment for long-term care insurance, an elder law attorney or a financial planner can really help look at all of those vehicles for protecting assets to make sure that this is the right asset for that person given their situation. And we can't provide that level of service, so it may be worth that person spending a couple dollars on an elder law attorney. Some resources. The Michigan Department of Insurance and Financial Services, their website's listed there. They have some really great information specific to the state of Michigan and who's licensed in the state of Michigan to sell long-term care insurance. The National Association of Insurance Commissioners is a great resource. They have some really great fact sheets, and they have a booklet, the NAIC's Guide to Buying Long-Term Care Insurance. That's a great resource for anybody to read if they're considering buying a long-term care insurance policy, and it's available via a free download, so somebody can download a PDF of that booklet. And then MMAP Inc. has a booklet too that's available as well. Well, thank you so much for attending the recording of the August 2015 training on long-term care insurance. If you have viewed this, please contact your site coordinator. Let her know that you have viewed this so that you can get credit for it. If you let your site coordinator know, she can work the appropriate magic so that you get credit for this. Thank you so much, and if you have any questions, let your site coordinator know.